Welcome to Think Beyond the Keys. I'm Melvina Fredson-Cole, and I hope you're having an amazing week so far. So this week, we're going to speak all about conforming loans. Now, I know you may have been hearing that um, 2021, the conforming loan limits has increased. But what is it? What does that mean for you? So I'll just speak a little bit about it, and I hope that you will take away something from this, okay? So, first, it's hard to speak about what conforming loan is um, without actually understanding the market, how the mortgage market works, how the secondary market works. I'm just going to give an overview, bird's eye view of what it is and how that came about. So, you know that when you want a mortgage, you go out and to a bank or a mortgage company and you ask them, like, hey, I want to buy a home. And then they tell you, bring all your financial papers or bring all these things. And then they give you the loan, you're happy, yay, and you have like a 30-year or 20-year or whichever amount that you need to purchase your home, right? However, let's think about this. It doesn't matter how much asset a bank has or a mortgage company has. At the end of the day, what will happen? They will run out of money to loan people, right? Yeah, that's what happened. It will be hard for them to borrow more people because they will run out of money. And the loans are not paid in a 1 year, 2 year period, right? They're paid like 30 years, 25 years. So one of the solutions that was cut that came up was in 1968, the Charter Act. They created the Federal National Mortgage Association and what we call, and we already know it as Fannie Mae, right? And then also Freddie Mac, which is actually the Federal Home Loan Mortgage Corporation. So what happens is these entities formed what they call a secondary market. See, secondary market. And they would buy these loans from banks, yes, from companies, and then they package it, they put them together. They have this whole thing that the way they do that and put it in mortgage-backed securities and trade it on Wall Street so investors can buy and all that kind of stuff. And it's an amazing thing for the secondary market because there's a lot of bankers, investors, and also you have so much different other things are in the secondary market. It's not only mortgage loans, right? I think student loans, car loans, all these kind of things you find them in the secondary market. But this is about mortgage loans. So they sell them in the secondary market. And so actually when they sell things like that, they're products, right? And no one likes to buy a crappy product. People likes high quality. Now for investors to buy these products, it has to be packaged to entice them. They have to see that they will benefit from it. They will get something from it. Because that's why they're investing. They're investing to make more money. They're not investing to lose money. So they want to make sure that these mortgages, these people that own these mortgages, they're paying, because that's how they get paid too, right? And so they form some standards. There are standards. And now Fannie Mae and Freddie Mac originally were formed. They were separate from the government, and they like quasi-government, and then they became private. However, we all know the 2008 crash, things happened. There's a lot of laws that passed. One of them was the Housing and Economic Recovery Act of 2008. And that formed actually the Federal Housing and Finance Agency. Yeah, Federal Housing and Finance Agency. And what that did, it kind of absorbed all these other agencies that were supposed to be regulating and into one under one roof, and they absorbed all that regulatory power. Now, because Fannie Mae and Freddie Mac were also in trouble, they also they came under conservatorship by the FHFA. Now, the FHFA, they set limits because I told you, in order for the products to be enticing to investors, right? They said that, okay, these loans, in order for you, Fannie Mae and Freddie Mac, to buy these loans, there has to be a limit. There has to be a loan limit. There has to be a credit limit, like a credit score, that at least credit score. They have to have the borrower's debt to income ratio cannot be more than certain percentage. I think it's 41%, depending on the type of loan. And so they put all these criteria together and say, these are the loans we will purchase. So that's why a lot of times you go to borrow money or refinance, they ask for all these things, because they need to make sure that it fits all that criteria, so they'll be able to sell it in the secondary market, right? And not everything is sold by the secondary market, by the way. There's some loans that are kept in-house, meaning some banks keep some of the loans, and there's some that they allow other people to service the loan. And that's why when you get you have your mortgage, and or you refinance, after a few months, maybe you receive something like, hey, we're now servicing your loan, or your loan has been given to this. So that's why you see all those kind of stuff. So that's what's going on behind the scene. Now, so conforming limits. Now there is a maximum that the FHA they allow Fannie Mae to buy. And this year, 2020, there was a maximum of $510,400. Anything above that was called a high balance loan. If it's above that minimum amount of mortgage loan, up to, I think the limit for this year was $765,600. So they set a floor, a maximum, but they also set a ceiling. And the reason why they set a ceiling, because face it, if you're in certain parts like New York, California, where I live, especially up north, and maybe some parts in Florida and other areas, no, a lot of people will not be able to qualify for this type of loan, right? Because we know homes are more than the maximum limit of $510,400. And even the ceiling that they put, $765,600, in some areas it's still pretty low, right? But that is the ceiling they put. Now, in 2021, the ceiling has increased. In 2021, the maximum that and then again, this maximum ratio is not for everywhere in the United States. I think the new increase, I think there are 13 counties that are not included in this. So check your county, or if you want to know more, let me know, okay? But they put a floor, and that is increased. And that's also came by the Housing and Economic Recovery Act of 2008, because we know that home values go up. So they just can't put a floor and a ceiling and leave it at that. So because the home value goes up, the conforming limit will go up every year as long as it goes up. They have the index that they use, and that's how they make those limits. So for 2021, the maximum loan limit that Fannie Mae and Freddie Mac will buy in the secondary market has increased to 548,250. So it increased slightly, which is a good thing, right? And whenever it increased slightly, the ceiling, it's that they don't just take it from thin air. It's normally 150% of the floor amount. And that, so for the high value, 2021 will be 822,375, 820, yeah, that's how it will be. So what does that mean for you? Well, this is what it means. When you take a loan up to the maximum, which is 548,250 in 2021, it means that it is rated a certain amount. If anything above that, up to the it's called a high balance. It's called a high balance. Now, when you have a high balance loan up to the ceiling amount, what happens is that the rate's a little bit higher, not too much depending. Remember that I said that they're packaged according to your credit score, they're packaged according to your debt to income ratio and other things, right? It's a whole package. So that's how your rates will vary. And when it gets to the high balance limit, what happens is that there are certain rates that goes up, and certain fees that also goes up. It makes sense, right? Because investors are taking more risk because it's more money, being given to that person. So the lower amount is a little bit lower risk, but the higher amount is a higher risk, and so it comes with that, right? More cost, right, for the product, right? And so that's what it means. So the good news is if you purchase your home like within a little bit above the maximum limit of 510,400 in 2020 or before, what happens is that now if you're between the 500, the new limit, which is 548,250, what happens is that you can go back and say, hey, I want to refinance because now you will not be under the high balance category, you'll be under the regular category. So that can save you, depending on a lot of other things, that can save you money. So basically, that's what it means when every year, if you hear that the conforming loan limits increased or whatever the case may be, you can always do a review, a mortgage review, ask, hey, what does that mean for me? Is there anything, would it save me? How would my rate look like? Because some of the things that some people sit on, they can save a lot of money, not only in interest rate, but in fees. And, if they just do a mortgage review, right? And so that is what the conforming and non-conforming is, and the secondary market. And just to know, there are loans obviously above the ceiling amount that Fannie and Freddie will allow to buy. So if your home you want to purchase is over the 822,375 for 2021, it's okay. There are jumbo loans. And then anything outside of that ceiling and you go outside and buy other loans, they're called jumbo loans or non-conforming loans. And there are investors that buy these type of loans, but the only thing is obviously it comes with higher interest, and different types of fees that it will come with because they're taking really a huge risk in buying those investment. Okay, so basically that's what it means. I hope you learned something today, and I'll see you next week when we'll talk about FHA loans. So just remember that loans are like products. You go to buy anything, they're different products. You go to buy cars, they're different models car, right? You have like the Lamborghini, you have all these things, the Mercedes and all that kind of stuff. You go to buy shoes, there are different types of shoes. So you go to buy loans, there are different types of loans, and they are called products. And they vary depending on what your financial situation is and what you want. So there are different types of loans. These Fannie Mae and Freddie Mac, they're insured, and so that's why a lot of people would like to get it. And so is FHA, the Federal Housing Association. I'll speak about it next week. And so is the VA, which I already spoke about it a few weeks ago. So these are the government loans, and you also have the USDA, which is for rural areas. I will speak briefly about it. Maybe next week if I have time, but more the conforming loans, which we'll call conventional loans, which is Fannie Mae and Freddie Mac, which I just spoke to you about, and also the FHA, which I'll be speaking to you about next week, and the VA. These are like some of the major government loans. But there are other loans, mortgage loans, that if you don't qualify for these, that you can get out, but they are expensive and they have stricter guidelines. You have to have like almost perfect credit and all that kind of stuff to get it. If you don't, it will be ridiculously expensive because they're taking a high risk, so that's how it works. So have a great week, and I'll see you next week at Think Beyond the Keys. Take care.